Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Charlie Dutton of Manulife Investment Management. Charlie is head of Emerging Market Equities and a senior portfolio manager. He has nearly 30 years of investment experience. Prior to joining Manulife, he was a portfolio manager with 91, a South Africa-based global asset manager, as well as a director of Asia Pacific Research at JP Morgan. Charlie, welcome to today's podcast.
Great. Thanks, Gary.
Charlie, obviously you have significant tenure in emerging markets over many cycles. How, if at all, has your process evolved?
That's a very interesting question. I think when I first started investing, obviously the investment universe was relatively narrow compared to where it is now. And I think the greater diversity you get in the number of stocks available for you to invest in means that your investment strategy can also evolve. I think effectively when I first started, the information flow was very much management-led from individual corporates, whereas now obviously the information flow you get on individual companies is much broader in terms of market share data, in terms of market knowledge. In terms of the actual style, my style hasn't shifted significantly. It continues to be that quality growth style of manager, but I think the opportunity set has significantly shifted.
And over those market cycles in your career, each one distinct with its own challenges to it, I'm just sort of wondering, are there any general takeaways or observations you've had over the various periods of time that you've sort of been an investor?
It's a great question. I think that every cycle throws up a new surprise. So whether that was the Asian financial crisis in 97, 98, I remember that as one of my first experiences in the market, whether it's the global financial crisis, whether it was SARS in Hong Kong, whether it was the COVID, whether it was the property implosion in China. Every cycle throws up new opportunities, but also learnings. And I think one of the takeaways I would always have is that balance sheet is absolutely core to risk, and that whether it's at a corporate level, a sovereign level, or a personal level, whenever you see balance sheet risks increasing, that's something which you need to discount heavily.
And is there still some aspect of emerging markets, do you think, that is currently underappreciated or misperceived by investors?
I think there are many aspects, actually. I still think global asset allocators probably look at emerging markets through the lens of are we positive or negative towards the China investment case? And I think emerging markets has evolved quite significantly from that. When you look at the opportunity set in emerging markets now, it's very diverse. And that means that it's a much broader asset base and it's got much better opportunities. So you can look at the technology opportunity, hardware build out from Korea and Taiwan. You can look within China at the bifurcation required for its technology supply chain. India is still an incredible standalone proposition. China plus one has created very strong economic growth in ASEAN, and LATAM has got some incredible investment opportunities coming through, particularly within the Mexican and Brazilian markets.
And Charlie, shifting into the discovery process and idea generation, what drives that? Is it screening tools, sector trends? You mentioned talking to management. What stands out to you? Where do you get your best sort of information from?
All of the above. So when we have a very sophisticated screening tool, we've got a fantastic quant team at Manulife. When we look at the investable universe within emerging markets, it starts at around the 2,000, 2,500 stocks based off a screen on market cap. We then put it through our quality growth screen, and effectively we end up with around 400 investable stocks from an emerging market perspective. But that's just the starting point. We will never invest on the back of the screen, because then it comes down to looking at dynamics within industry, within market share within those industries, looking at the return dynamics, making sure that we have a close relationship with management and understanding the strategic direction that those businesses are going to take, and then obviously applying very strict criteria around valuation. Really what we're looking for, though, is structural growth. We try and avoid cyclical growth as much as possible, because that's obviously much harder to call and outside the control of individual companies.
And the artificial intelligence overlay, the tools there, is it still early? Is that changing at all how you source ideas or manage portfolios?
So it's a great question again. So the number of aspects we look at from an AI perspective, we use AI in one way to improve the efficiency of the team, and the way I'd kind of categorize that would be when it comes to looking at how we implement ESG. So you're able to use our ESG tool, which enables us to look at ESG characteristics of companies relatively more efficiently than we were previously. When you use AI to look through an earnings call, you're able to take the earnings call, disseminate it in a much quicker, more efficient manner. So those are examples of how we're using AI to improve the efficiency of the business. But what it's certainly not doing is shifting the way we're actually approaching individual businesses. The other aspect is, AI, I think, kind of blurs into all sorts of different aspects now. But when it comes to portfolio construction, we're using increasingly sophisticated tools to make sure that we've got the best risk return or risk-adjusted returns within the portfolio, that we've got the correct position sizes, that we haven't got unrealized correlated risk between different positions. So whether you want to define that as using AI or not, or just more sophisticated tools, that's something we're certainly applying more and more.
And as we meet today, obviously a very dynamic investment environment with geopolitical tensions driving the narrative. Overall, how would you characterize the macro environment for emerging markets?
If you were to ask me that question 6 weeks ago, it would be a very different answer to the one now. 6 weeks ago, it would have been decidedly bullish. As I mentioned earlier in the podcast, the tech hardware build out is an incredible tailwind for a lot of North Asia. You've got a very strong GDP growth within ASEAN as well. LATAM again was going through a tremendous growth period. You're obviously in a period where US dollar weakness had occurred in 25, and that was predicted to continue into 2026. Therefore, that was going to be another tailwind. Now, you roll forward to where we are now, and there's obviously a great deal of uncertainty. I don't think the emerging market investment case has been derailed as such. But if oil stays above 100 for the rest of the year, then that obviously puts very different fiscal and monetary pressures on emerging markets, and therefore will reduce growth quite significantly going into 2027.
Any other commodities that you're focusing on closely in the current environment?
We always keep an eye on commodities, and we focus on them. But we don't. It's not part of our investment prerogative from an emerging market team perspective, because that tends to sit more within the cyclical sector. We obviously are fascinated in terms of the aspect of what's happening to gold at the moment, what's happening to silver, what's happening to lithium. Really, when we look at commodities, it's as much to make sure that the input prices of the companies that we analyze, we fully understand, and therefore we have a good understanding of where the economics of those businesses are going, but we don't directly invest in individual commodities.
And you talked about, where we were a few weeks ago, where we are to now today. How is that affecting your approach to stock selection of the market in general?
So we certainly reduced some positions which we think are directly impacted from the oil price rise. We've slightly reduced positions within our India part of our book. India is a country which has probably one of the highest vulnerabilities to oil price increases or energy price increases in emerging markets in Asia. So we've made some minor adjustments on that side. And I would like to emphasize the idea of minor there. Again, the stocks we're invested in tend to be more structural in nature rather than cyclical. So, when we look at this input price increase, we just need to make sure that we fully discounted that within the economics of those businesses going forward, and that the valuations discount that.
So do you require a higher margin of safety basically in investing right now?
Absolutely, Gary.
And does volatility create opportunity as well?
Yeah. So, I mean, higher margin of safety from that perspective, we have a cost of capital model which we apply to all our companies in emerging markets. Obviously, that varies by country. That cost of capital model is being adjusted at the moment because inflation and interest rate expectations are having to be adjusted. So we actually adjust it through that cost of capital model, which you could, as you described there, say that we're looking for a higher margin of safety.
And moving to potential upsides in the market, are there areas you're saying, wow, there could be potential upside surprises this year to the positive in emerging markets? And if so, where do you think they might come from?
I mean, I think the positive trends we're seeing coming through from technology build out in Korea and Taiwan, we don't think are going to change. Are there going to be positive surprises around that? Not necessarily, but is the duration of that cycle going to be longer than perhaps the market is implying? I think that could be the case. I think it could be longer in duration. I think you could be looking, the positive surprise, really, to be honest, from here would be an improvement in the geopolitical situation in the Middle East, that oil prices come down, that inflation then comes back to, or inflation expectation or interest rate expectations come back down to where they were, because emerging markets going into the end of 2025 and the beginning of this year were very well placed, and currently that's less certain.
And shifting into themes, you touched on technology. What other themes are out there that you think are particularly compelling right now, and how is that driving the approach?
So I think when you're investing in emerging markets, one of the things you're obviously investing in is the rise of the middle class. You're looking at consumption growth coming through, and when you look through, whether it's in LATAM, Asia, EMEA, that you can see that is still very much a theme for us. And we look for those companies which we think are really going to benefit from that consumption growth. Now, what's interesting there is that there is definitely an aspect of a bifurcation in terms of where consumption growth is coming from. It either tends to be very much at the high end or at the low end. So your discount type of store format, or your luxury brands. And that's where we're really looking for exposure. So that continues. We still look for digitalization. So although we've got technology hardware build out from Korea and Taiwan, what's happening across emerging markets is movement to online platforms, an ability to look at what's happening within e-commerce, what's happening within fintech, and those are still very, very strong thematics coming through and have got very good structural growth.
And as far as portfolio construction, what are the sort of key quantitative or qualitative metrics that you're most focused on when you construct that initial investment mosaic?
I mean, on that side, there are a couple of aspects. So when we take a position size, we will base it around three different aspects. Obviously, the larger position sizes have the triumvirate of valuation support, have good growth characteristics, and have good quality characteristics. And we will adjust position sizes accordingly around those three core aspects. Now, the different mosaic and the different layers, as you highlight there, which we then put upon that, would be, well, if we find two companies in the same sector which we like, you do want to double up on the same exposure, so you have to adjust the portfolio position size accordingly to make sure you haven't got higher risk than you'd want a particular sector or a particular country. Conversely, there are some stocks which we look at which we really like. We think they've got fantastic quality characteristics or valuation, or quality characteristics or growth characteristics, but the valuation might be at the higher end of the range that we would like to pay for it. In order to differentiate that and to take that into account, we'd start with a smaller position size, because although if it continues to execute well, it will give good performance. If there's any speed bump in that roadmap that it has for that quality and growth, that will then give us the opportunity to add to that position.
And now a word from our sponsor. If you lead or advise at a financial services firm, this may be something to keep on your radar or to share with a colleague. Harvard Business School offers leading professional service firms a 5-day in-person program for working executives to explore topics like corporate culture, talent retention, and how to deliver consistent client value. Held on the HBS campus in Boston, this program focuses on leadership and strategy by working through real challenges at professional service organizations. You'll build a global network across industries and engage directly with HBS faculty. To learn more, visit hbs.me/client. That's hbs.me/client. And when you look at these companies, how do you distinguish between a company with sort of a sustainable competitive advantage and durable growth versus one that's simply riding a trend?
What a question. So, I mean, to some degree, you could say they're one and the same thing. So, riding the trend is a good thing if you're able to sustain that. I think the key aspect there is we like to look at businesses which have an element of history. And what I mean by that is that you will need to be able to look through a cycle. So there can be a structural growth aspect, but if you're able to also look through an economic cycle and the pricing power that those companies had through an economic cycle, it shows you whether they're simply riding the trend or if they've got that pricing power and able to maintain that margin through the cycle because their ability to price is driven by them. They're a price giver rather than a price taker.
And back on valuation, what are there particular metrics that you, or sort of your go-to metrics for valuation that you focus on?
Sure. We very much, our key metric really is around cash flow and different elements around that. But obviously outside financials, we build DCFs on all our models. We have our cost of capital model that we put on top of that. We want to see what type of free cash flow generation is coming through from individual businesses, but then what type of use of is being used actually for that cash flow. What I mean by that is like, are they reinvesting that at very high levels of return? Are they doing sensible M&A if that's something that they want to do? But also, are they returning excess cash to shareholders in the form of dividends and share buybacks?
And emerging markets as a whole still valued a fairly sizable discount to developed markets on a forward earnings basis. How do you assess that gap, and what catalyst do you see that might narrow that?
I think to break that down, really, you want to look at the constituents of indices, and the S&P 500. If we just take that as the most significant developed market indices, it's incredibly efficient in the way it's structured. So, good companies get bigger within that and become a bigger portion of that index, and companies which fail to perform or business models become under pressure actually get kicked out of the index. The result of that is that's always, to me, going to be a index which has got high performing companies in it over time, but also therefore likely to be at quite high multiples. You don't get the same capital turnover or name turnover within emerging market indices. There just isn't that new generation of stocks constantly coming through. So I think you will always have EM trading at a discount to DM or within current monetary conditions, and obviously unless there's a significant change in some aspect of that. And to some degree, that reflects that there'll be a lot of companies within EM which are more traditional companies. So they might be state banks, they might be heavy industry, they might be telecoms, they might be utilities. They're unlikely to trade at significant premiums, but there will be elements within all of those indices which are high valued companies because they reflect the high quality and high growth characteristics of those businesses.
And Charlie, you mentioned cash flow as a metric for valuation. How do you go about assessing management as good allocators of cash flow? What distinguishes a good one from one that's not going to be investable?
A great question. I mean, our preference is always an ability for companies to reinvest their excess cash back into the companies that they're operating at high rates of return. So businesses which are able to do that and management should be able to direct that capital back in that direction are very highly valued. The next aspect obviously is that we want to see that if they don't have a place for that excess capital, that they return it to shareholders. And again, that shows good capital management coming back in terms of share buybacks or dividends. Flags for us is where you get investments in non-core assets. We also don't tend to focus on companies which rely on growth through M&A roll-ups, because again, that can create complications. So they're all different elements we look for, but primarily is that focus on the core business and ability to return capital to shareholders.
And do you look at all at insider buying? Is that anything of an indicator, or is
Yeah, it's not as big an indicator in emerging markets as a whole compared to developed markets. Often you'll see that owners of businesses have very considerable ownership of companies. They tend to be the founder owner or the family ownership within that. So it's not such an element within emerging markets. Having said that, we obviously collect all information available to us, and anytime we see flags in terms of insider buying or selling, it's something of interest to us.
shifting into portfolio construction? Are there particular geographies that you view more favorably today than others? And what would a portfolio look like based upon geographies?
Um, just based on geographies, this is a bottom-up portfolio that we run. Therefore, the outcome of the geographical split within the portfolio represents where we see the individual stock opportunities. Often, though, that does reflect underlying market caps within countries. So you'll see that within an emerging market perspective, in a very simplified version, China, India, Korea, Taiwan, and LATAM are the major components of the emerging market index. ASEAN and the Middle East are slightly smaller, and more or less that reflects our exposure within the geographies. Now, where you'll get shifts around the core benchmark there will be around the opportunity set. So we've got no issue with moving that quite significantly, but then that comes back into the aspects we talked about previously, Gary, which was we want to make sure we've got diversified risk within the portfolio, and that can be achieved both by industry but also by country. So we don't want to have too much of a concentration around individual countries or industries, as that creates undue risk.
And what about sectors? Are there sectors you're particularly bullish on, particularly overweight right now?
So on that side, it won't come as any surprise. Information technology is something which we are pretty bullish on. We always find a lot of opportunity actually within financials. Financials, you might think, well, isn't that just state banks and the quasi government institutions? It's not actually the case. That a lot of the financial exposure that we have tend to be the private banks, which are very engaged around digital enablement, have very good, strong digital platforms, so more fintech in nature. So that's always an opportunity for us. Consumer names is something which we always have a strong focus on, and healthcare as well, actually. But the healthcare sector within emerging markets is still very much evolving and isn't as significant a part of the index as developed markets. From a industry perspective, which we don't tend to have as much exposure to, it tends to be the utilities, telecoms, materials, resources. There's more the stocks which are very highly regulated or have a cyclical nature to them.
And stepping back from this, if you're an investor who can sort of allocate capital around the world globally, what role do emerging markets play in a diversified portfolio?
Yeah. So you could argue, Gary, that for 10, 15 years, it didn't play a role for the reason being that developed markets, and when we say developed markets, we're really talking the S&P and North America, performed so well for such a long period of time that the diversification aspect of emerging markets was wasted because of lower returns. Now, I think as we've seen in 2025, we saw at the beginning of this year until we saw the geopolitical flare-up in the Middle East, US dollar weakness does lead to strong emerging market equity performance. If you look back over the last 20 years, there's almost direct correlation between emerging market equity performance and US dollar weakness. So I think it certainly diversifies risk away. I think if you were looking at asset allocators on a global basis at the moment, you'd see obviously a very significant focus and concentration around North American assets and around information technology and the tech space. Therefore, diversifying from that, I think, is an important element. And emerging markets, through the fact that some of the aspects we've talked about today have such a wide range of elements driving them, that you can get further diversification through investing in emerging markets.
And what's the thinking or process behind when to substantially increase a position on a stock, and that might not be working out particularly on a price performance basis?
So we have a very stringent investment process which we go through when we look at allocating capital to a stock. Once we've gone through that process and got to a point where we are as comfortable as we can be, you're never going to get to 100% in terms of comfort level. There's always going to be an unanswered question here or there. But once we get to that point and we take a position, what we'll often be is, because we've done such detailed analysis on those individual businesses, and we've particularly seen this more recently when you get earnings surprises, both positive or negative, but particularly when you get a negative surprise, if we're able to understand what's happened within that, we're comfortable with it, and perhaps it could be that they're reinvesting more for future growth, but that's hit short-term earnings. That to us would be an opportunity to invest, because we're very happy to take that shorter-term hit if it means that longer-term growth prospects are still intact.
And taking profits, how does that decision
there's three main aspects we look at there in terms of taking profits. One will be on a valuation basis. We have strict target prices on stocks that we look at. As they approach those target prices, then we will look to trim and take profit. There could be the case that the investment case has changed or shifted, or we didn't get it correct, in which case we will sell that position. And then the third one will be around competition for capital. So on the competition for capital side, we're constantly looking at new ideas. So we might have a position in the portfolio which we like, but then we find something which we prefer, which we think will be additive to the portfolio in terms of risk and return, and so the old position will be exited.
What about risk management? I mean, how do you think about that, country versus sector versus individual stock? How do you navigate that? And is it mostly through just diversification?
I mean, you've almost answered it for me there, Gary. So thank you. It's a concentrated portfolio. As such, the risk really lies at a stock level. So the risk diversification really comes about from doing the underlying performance of the individual stock, and by doing it to a great deal of detail, that's where we think we diversify the most risk. In terms of the portfolio construction on a wider basis, as I say, we have the risk tools that we put the portfolio to make sure that we haven't got unrealized correlated risk amongst different positions within different industries and from a country basis. But really, the risk analysis and how we look at individual stocks is where the risk process really starts.
Lastly, we've covered several topics here, from process and construction to portfolio construction to navigating market uncertainty. In summary, what's the playbook here for emerging markets, you say, over the next 12 months?
I think the key would be there to make sure that we go back to, or when you're looking at emerging markets over the next 12 months, is making sure that you're looking at individual stocks from a bottom-up perspective. I think trying to take a market call on emerging markets at this point would be extremely difficult. I mean, we don't know where oil's going to be next week, in a month's time, or in 2 months' time, 6 months, 12 months, whatever it might be. So I think trying to make that call is difficult. As a result, where inflation is going to be, where interest rates are going to be is very difficult. So pull it back to where you're seeing interesting investment opportunities from a bottom-up perspective, which has that structural growth, where you have that level of comfort and visibility on earnings going forward. And I think that's got to be the playbook at this point in time.
Charlie, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society, New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client.